Hi, this is David with TaxLayer Pro, and in this presentation, we'll give you an update to the Affordable Health Care Act. Unless you've spent the last 4 years living under a rock or exploring the Amazon River Basin, you know that the Affordable Health Care Act, sometimes known as Obamacare, has had a considerable effect on the American healthcare system and the economy in general. Significant healthcare changes have already been set in motion and will continue in the years ahead, shifts that will touch virtually every American. If you recall, on March 23, 2010, President Barack Obama signed into law a sweeping reform of the nation's healthcare system, handing down to the American people with a stroke of his pen the Patient Protection and Affordable Care Act. As the new healthcare system becomes fully operational, it will change the way all of us live. That's because it restructures the delivery of healthcare in our nation, a system everyone must rely on to some degree during the course of our lives. For most people, the Affordable Care Act had no effect on their 2013 federal income tax returns. However, for some people, a few provisions affected their tax returns, such as increases in the Itemized medical deduction threshold, the additional Medicare tax, and the net investment income tax. Most people who itemized their deductions for 2013 claimed deductions for unreimbursed medical expenses that exceeded 10% of their adjusted gross income. Previously, the law permitted deductions for unreimbursed expenses in excess of 7.5% of their adjusted gross income. There is a temporary exemption for individuals age 65 or older until December 31st, 2016. If you're 65 years or older, you may continue to deduct total medical expenses that exceed 7.5% of your adjusted gross income through 2016. If you're married and only one of you is age 65 or older, you can still deduct total medical expenses that exceed 7.5% of your AGI. This exemption is temporary. Beginning January 1st, 2017, the 10% threshold will apply to all taxpayers, including those over 65. The additional Medicare tax went into effect in 2013 and applies to wages, compensation, and self-employment income above a certain threshold amount. The additional Medicare tax rate at this time is 0.9%. A taxpayer is liable for additional Medicare tax if the wages, compensation, or self-employment income, together with that of a spouse if filing a joint return, exceed the threshold amount for the filing status on the tax return. The additional Medicare tax liability is calculated on individual income tax returns using Form 8959, Additional Medicare Tax. Taxpayers also report additional Medicare tax withheld by their employers on Form 8959. This amount is included with the amount of federal income tax withheld on Form 1040, line 62. The net investment income tax applies at a rate of 3.8% to certain net investment income of individuals, estates, and trusts that have no income above certain threshold amounts. The net investment income tax went into effect January 1st, 2013. It doesn't affect income tax returns for the 2012 taxable year filed in 2013. In general, investment income includes interest, dividends, capital gains, rental and royalty income, non-qualified annuities, income from businesses involved in trading of financial instruments or commodities, and businesses that are passive activities to the taxpayer. To calculate and report the net investment income tax, individuals, estates, and trusts use Form 8960. For individuals, the tax will be reported on and paid with the 1040. For estates and trusts, the tax is reported on and paid with Form 1041. As an example, assume a single filer has $180,000 of wages plus $90,000 from passive partnership interest, which is considered net investment income. His modified adjusted gross income is $270,000. This income exceeds the threshold of $200,000 for single taxpayers by $70,000. Remember, his net investment income is $90,000. The net investment income tax is based on the lesser of $70,000, the amount that taxpayers' modified AGI exceeds the $200,000 threshold, or $90,000, the taxpayer's net investment income. The taxpayer owes a net investment income tax of $2,660, which is $70,000 times 3.8%. The open enrollment period to purchase health care coverage through the health insurance marketplace for 2014 began October 1st, 2013, and ran through March 31st, 2014. If a person got health insurance through the marketplace, he or she may be eligible for the premium tax credit that will immediately help lower the monthly premium. In 2014, the premium tax credit can help make purchasing health insurance coverage more affordable for people with moderate incomes. Premium tax credits are available to individuals and families with incomes between 100% of the federal poverty line, which is $23,550 for a family of 4, and 400% of the federal poverty line, which is $94,200 for a family of 4, who purchase coverage in the health insurance marketplace in their state. The premium tax credit will be calculated by the exchange. In general, a person may be eligible for the credit if he or she meets all of the following criteria: bought health insurance through the marketplace, is ineligible for coverage through an employer or government plan, is within certain income limits, doesn't file a married filing separate tax return except for certain circumstances, and cannot be claimed as a dependent by another person. For example, according to the Marketplace Exchange, John is eligible for a premium tax credit of $35.52 a year. During the open enrollment period, he chose to purchase the second lowest cost silver plan, the benchmark plan, for the upcoming year, which has an annual cost of $5,000. He decided to take the premium tax credit in advance, which means that the IRS will send the monthly payment of $296 directly to his health insurer. This brings down John's portion of the health insurance premium from $417 to $121 per month, which he will pay the insurer. A person can elect to have advance payments of the tax credit sent directly to his or her insurer during 2014, or wait to claim the credit when he or she files a tax return in 2015. If advance payments are sent to the insurer, the payments will have to be reconciled on the 2014 tax return filed in 2015. The amount of the advance premium tax credits that people receive is based on an estimate of the income the household expects for the year. The final amount of the credit is based on their actual income as reported on the tax return for the year the advance payment was received. This means people whose income for the year is higher than they previously estimated could have to pay back some or even all of the advance payments they received. On the other hand, people whose income ends up lower than estimated could get a refund when they file their taxes. For example, Peter, Mary, and their 2 children estimate that their income in 2014 will be $52,988. The marketplace determines that they're eligible for a premium tax credit of $11,198 for the year. Peter and Mary decide to take the credit in advance, and the credit is sent directly to the insurer. When Peter and Mary file their 2014 taxes in February of 2015, it turns out that their income was a little bit higher than they estimated because Peter received a $2,000 bonus. The family's final credit amount is $223 less than the advance payments they received. $10,975 compared to $11,198. This means that at tax time, if the family was due to receive a refund, the refund would be reduced by $223. How will your client claim the credit? If your client receives advance credit payments or plans to claim the premium tax credit, he or she must file a federal income tax return for that year. If your client chooses to get advance payments now, when your client files his or her 2014 tax return in 2015, the total advance payments received during the year will be subtracted from the amount of the premium tax credit calculated on the tax return. If the premium tax credit computed on the return is more than the advance payments made during the year, the difference will increase the refund or lower the amount of tax owed. If the advance credit payments are more than the premium tax credit, the difference will increase the amount owed and result in either a smaller refund or a balance due. If your client chooses to get the credit later, he or she will claim the full amount of the premium tax credit when they file their 2014 tax return in 2015. This will either increase the refund or lower any balance due. If a person is already receiving advance payments of the credit, nothing needs to be done at this time unless there is a change in circumstance, such as income, marital status, or family size changes. These life changes need to be reported to the health insurance marketplace. Starting in January 2014, all of us must have health care coverage, have an exemption from coverage, or make a payment when we file our 2014 tax returns in 2015. Most people already have qualifying health care coverage and won't need to do anything more than maintain that coverage through 2014. Your clients won't need to report minimum essential coverage or exemptions or make any individual shared responsibility payment until they file their 2014 tax return in 2015. Later this year, the IRS will make information available on how to report coverage or exemption or make a payment on 2014 income tax returns. But the individual mandate is likely to be a paper tiger in 2014 for two reasons: the availability of hardship exemptions and lax enforcement. The application for a hardship exemption lists 14 different qualifying categories. They include people who would have qualified for Medicaid under the law, but their states have opted not to expand Medicaid coverage. Exemptions are also available to individuals who've been homeless, victims of domestic violence, filed for bankruptcy, or had their existing plan canceled. And the final category listed on the application is the broadest. You experienced another hardship in obtaining health insurance. The standard for proving that hardship: please submit documentation if possible. Basically, anyone who wants to be able to claim a hardship exemption will probably be able to do so, said David Howard, a professor at Emory University's Rollins School of Public Health. That's a view that's held widely among both the law's supporters and detractors. If your clients or their dependents don't have minimum essential coverage and don't have an exemption, they'll need to make an individual shared responsibility payment on the federal tax return. It's important to remember that choosing to make the individual shared responsibility payment instead of purchasing minimum essential coverage means that your clients will also have to pay the entire cost of medical care. If your client chooses to have health care coverage, qualifying coverage includes health insurance coverage provided by an employer, including COBRA and retiree coverage, health insurance coverage purchased through a marketplace, Medicare, Medicaid, or other government-sponsored health coverage, including programs for veterans, or coverage purchased directly from an insurance company. If your client must make an individual shared responsibility payment, the annual payment amount is the greater of a percentage of the household income or a flat dollar amount. The payment is capped at the national average premium for a bronze level health plan available through the marketplace. Your clients will owe 1/12 of the annual payment for each month they or their dependents don't have either coverage or an exemption. For 2014, the annual payment amount is the greater of 1% of household income that is above the tax return filing threshold for the filing status, or a family's flat dollar amount, which is $95 per adult and $47.50 per child, limited to a family maximum of $285, but capped at the cost of the national average premium for a bronze level health plan available through the marketplace in 2014. Calculating the payment requires the household income and the tax return filing threshold. Household income is the AGI from your client's tax return, plus any excludable foreign earned income and tax-exempt interest received during the taxable year. Household income also includes the incomes of all dependents who are required to file tax returns. Tax return filing threshold is the amount of gross income an individual of your client's age and filing status, for example, single, married filing joint, head of household, must make to be required to file a tax return. Let's look at an example. Jim doesn't have the minimum essential coverage for any month during 2014 and doesn't qualify for an exemption. For 2014, Jim's household income is $40,000 and his filing threshold is $10,150. To determine his payment using the income formula, subtract $10,150, which is his filing threshold, from $40,000, the 2014 household income. The result is $29,850. 1% of $29,850 equals $298.50. Jim's flat dollar amount is $95. Because the $298.50 is greater than $95, Jim's shared responsibility payment for 2014 is $298.50, or $24.87 for each month that he is uninsured. Jim will make his shared responsibility payment for the months that he was uninsured when he files his 2014 tax return due in April of 2015. Again, your clients may be exempt from the requirement to maintain qualifying health insurance coverage called minimum essential coverage and may not have to make a shared responsibility payment when they file their next federal income tax return. They may be exempt if they have no affordable coverage options because the minimum amount they must pay for the annual premiums is more than 8% of household income. They may be exempt if they have a gap in coverage for less than 3 consecutive months, or they may be exempt if they qualify for an exemption for one of several other reasons, including having a hardship that prevents them from obtaining coverage or belonging to a group explicitly exempt from the requirement. A special hardship exemption applies to individuals who purchased their insurance through the marketplace during the initial enrollment period for 2014, but due to the difficulties during the enrollment process, have a coverage gap at the beginning of 2014. A business with 50 or fewer employees can purchase affordable insurance through the Small Business Health Options Program, or SHOP. Employers must withhold and report an additional 0.9% on employee wages or compensation that exceeds $200,000. Employers may be required to report the value of the health insurance coverage provided to each employee on his or her W-2. Effective for calendar year 2015, if self-insured health coverage is provided to employees, employers must file an annual return reporting certain information for each employee you cover. This rule is optional for 2014. Your tax client's small business may be eligible for the Small Business Healthcare Tax Credit if the business covers at least 50% of its full-time employees' premium costs, has fewer than 25 full-time equivalent employees with average annual wages of less than $50,000. For tax years beginning in 2014, the maximum credit increased to 50% of premiums paid for small business employers and 35% of premiums paid for small tax-exempt employers. To be eligible for the credit, a small employer must pay premiums on behalf of employees enrolled in a qualified health plan offered through a Small Business Health Options Program marketplace. The credit will be available to eligible employers for 2 consecutive taxable years. How do you claim the credit for your client? You have to use Form 8941, Credit for Small Employer Health Insurance Premiums, to calculate the credit. A small business will include the amount as part of the general business credit on the income tax return. Some of the provisions of the Affordable Care Act apply only to large employers, generally those with 50 or more full-time equivalent employees. For example, in 2015, large employers will have annual reporting responsibilities concerning whether and what health insurance they offered to their full-time employees. It's estimated that there will be 47 million Americans seeking health insurance. Tax preparers who understand the Affordable Health Care Act can help clients avoid penalties and even gain credits and subsidies. The Affordable Health Care Act may add additional revenue to your tax office through tax credit forms and insurance referrals. It's expected that the law will require individuals to file a proof of insurance form as well as a tax worksheet to calculate the subsidy tax credit. TaxSlayer Pro has partnered with VelaPoint, one of the leading companies in the United States that provides health insurance. Through VelaPoint, you'll be able to offer affordable health care insurance to your clients. VelaPoint is one of the foremost insurance brokers in the United States. Through this partnership, TaxSlayer Pro and VelaPoint will help educate you on the affordable health care laws and provide you with a real opportunity to earn additional revenue through a seamless referral system. This is a fast, simple, and most importantly, easy way to earn additional revenue simply by referring your customers to VelaPoint for their health care needs. For each qualified referral that you send to VelaPoint, you'll receive up to $5. VelaPoint will handle answering questions, figuring eligibility for the healthcare credit, and servicing after the sale. This will allow you time to complete more tax returns and earn additional revenue through referrals. 2014 is expected to be a big year for tax preparers. TaxSlayer Pro's partnership with VelaPoint will give you the confidence in knowing that you'll be educated on the affordable health care laws and earning real revenue in a fast and easy way. Log into your TaxSlayer My account and enroll to offer VelaPoint insurance to your clients. How does the TaxSlayer program allow for EROs to help a taxpayer with a VelaPoint insurance application? First, start a tax return. Enter the taxpayer's personal information. Review the taxpayer's personal information. Then, during the next step of the personal information interview process, the TaxSlayer program will ask the question shown below. Does the taxpayer have health insurance coverage? Answer no. Question 6, health insurance status, will show not covered. If you answered no to the health insurance coverage question in personal information, a couple of questions will appear as you prepare to exit the tax return. Would the taxpayer like to be contacted by VelaPoint for more information? You should print the VelaPoint disclosure. Here's an example of the consent to disclosure of tax return information for VelaPoint. Telling the client, you've indicated that you're interested in obtaining more information regarding insurance products from VelaPoint. By signing below, you authorize us to disclose to the service provider your tax return information. Follow these steps to increase your revenue. Complete your client's tax return and send qualified leads to VelaPoint. Each qualified lead that you refer will net you as much as $5 per lead. Once you send the qualified lead, VelaPoint will handle the rest, including completing the application, answering questions, and selling the policy. The process is very easy and seamless. VelaPoint's lead generation system is integrated within the TaxSlayer Pro software. As the ERO, you can do what you do best, completing tax returns. This is a great opportunity for you to earn additional revenue with little effort on your part. Under our current system of government, laws are certainly not written in stone. Congress can modify or repeal them. The President can refuse to enforce them. The courts can strike them down, and election results can change the nature and implementation of laws. Like any other law after its enactment, Obamacare exists in a fluid state. It's likely that new developments will cause the law to mutate into something much different than what it is today.